Hi, good morning. I hope you're well. Happy Friday to you. I hope you're looking forward to the weekend. Yeah, look, I'm getting better at this whole video stuff. I figured out how to get backgrounds working. Let's see how this continues to go. So just, I guess, another video on weekly or fortnightly look at the markets, just to run through with you what's been happening. Quick update. You can just listen to this and run through it. So where are we at right now? Okay, so there's been a substantial amount of data coming out in the economy. Lot of information for people to process. So market sentiment right now, risk appetite remains strong. Okay, so risk assets, we're typically looking at things like technology. We've seen a big boost since the start of the year. Recessions in the US and the Eurozone look as if they may well now be avoided. Okay, so inflation's starting to come down month on month, and the market's like it. All right, so from the information that's coming out, central banks look as if they're going to either ease or end their interest rate increases. And the labour market is seriously robust right now, supporting demand. So what that means is pretty much anyone that really wants a job can get one, and wage inflation's on the up. So companies are looking to also keep hold of people that they've got, despite some layoffs. All right. Corporate profits coming out, so real mixture, as I'll briefly move on to in a minute. But just to remind you all, the war on inflation is not over yet. Okay, so Jerome Powell of the Fed and Christine Lagarde of the ECB, they said last week that investors still need to be careful. They still may need to price in more interest rate increases if they can't get a full handle on headline CPI inflation, which excludes energy and food. All right, still proving to be a bit stubborn. As I mentioned just a minute ago, risky assets have held on to their January gains. Okay, so tech-heavy Nasdaq is up 15% since the start of the year. Bitcoin is up 37% to around $22,700. And we've seen those bounce back significantly. All right, is it a good investment now? Well, if you ask me, in my opinion, I think we should have been looking to invest in tech last year, but definitely still take advantage of it now. Technology is going to be the future of everything that we do moving forward. US corporate results, again mentioned it a minute ago, real mixed bag. Half the S&P 500 companies have already reported their results so far. And as expected, industrials and energy have outperformed, while consumer discretionary, consumer services and tech are the worst performing. Okay, if you're an energy company, you're in high demand. Okay, as inflation comes up, you've got physical assets. Okay, last week saw Amazon, Apple, and Alphabet all release week numbers last week. Decelerating revenue and also looking to reduce costs. So we'll see. Big tech always will do well over the long term, but just something to be aware of, that it does take up a large chunk of funds or portfolio holding. Even though Meta had a 4% fall in profits, by announcing cuts in the research and development budget for the metaverse that Zuckerberg has been promoted, they've actually managed to have a big increase in their share price. So again, it's still very choppy, still very volatile, and let's see. But in my opinion, tech is a good buy now, and definitely something that if you're thinking about the longer term, it should be something to include in your portfolio now. Okay, energy companies, well, they're reaping all the benefits, basically imposing a Putin dividend. Obviously, with the situation going on in Ukraine, energy prices have gone up because of sanctions on Russia. And part of a result of that is that voters in certain countries are now looking for windfall tax to be applied onto these energy companies to stop them reaping these huge benefits. Is energy a good investment now? Well, it has a number of factors that need to be considered. If you look at OPEC Plus, they're looking to keep the oil price quite high. It benefits them, of course, and as they control all the energy, then yeah, they can control the supply and demands that's in the market. So we'll see what happens going forward on that point. Again, if you've got any questions on that, please reach out and touch base with me. FTSE 100, it's reached a new high. Okay, again, helped by profits from the energy companies, from the likes of Shell and BP, and also some solid results from banks, insurers, and consumer staples. Might be worth noting that FTSE 100 companies, okay, it's the biggest 100 companies in the listed in the UK, but actually 2/3 of those profits originate from overseas because these companies are global. You look at HSBC. HSBC is not just a bank in the UK; it's a bank everywhere. You look at BP. They're not just in the UK; they're everywhere. All right, so something to bear in mind when looking at investing in the FTSE 100. EU and US green subsidiaries will be the topic of discussion at the EU summit this week. President Biden last year announced his $370 billion package for clean energy projects. Obviously great that a large country has taken such a key interest in this, or the world's leading country taking a key interest in this. The problem is it distorts global investment in green energy, okay? Because what happens is with that investment, they suck up projects from around the world, from lots of different countries. Okay, and actually some of those countries need those companies there to help develop their technology base. And you know what we're seeing is that the US and China could end up dominating clean energy market and therefore having a monopoly on prices in that sphere. So expect it to do well. Of course, $370 billion investments, huge, but there is a bit of friction there with projects moving out of home countries over into the US or Chinese markets. So that's just a brief update, some things to look out for, some things to read upon. May have seen my email this week. We have a fantastic opportunity through De Beer at the moment. 3-year structured product with capital protection built in, offering 36.1% per annum returns in US dollars. Okay, that sounds crazy. That sounds highly unlikely. But actually, if you look at the underlying stocks, okay, e-commerce giants, Amazon, Alibaba, Mercado Libre, okay, this is a really, really attractive return for investors that are looking for something short term, looking for some downside protection built in, as well as some huge upside potential. If you haven't already seen my video, please have a look at one of my other emails that I've sent out. Likewise, give me a quick call. Let's have a discussion about it. If this is a little bit too spicy for you, okay, well, we do have a fixed coupon version that's 2.75%, much, much lower. And of course, a bit safer. There's always an element of risk when investing, but as it says down here, please contact me if you've got any questions. I'd love to speak with you about it. I think it's probably the best opportunity that we've ever generated for clients, and something really worthwhile at least having a discussion about. All right. Listen, have a good weekend. Enjoy yourselves, try and relax, and hopefully I'll get to hear from you soon. Let me know what you think about this. I mean, this is all new for me, because any feedback's great. All right. Thank you very much. Bye now.